Well, hello, it's Richard Pearce from FinextraTV, and today I'm joined by Dr. Nina Seega. She's the Director for the Centre for Sustainable Finance at the University of Cambridge Institute for Sustainability Leadership. Hello, how are you?
I am very well, thank you. And let me congratulate you on not mangling the name of the institute, which most people do.
Oh, really? Oh, well, normally I do. I think I'm famous for it. So it's some miracle. I'll probably do something else in a moment. Listen, it was great to brief. I sort of rushed up to you at the Royal College and said, look, we've got to talk about what you were presenting about and also the work that you're doing. And you know that was a great event, and hopefully you can sort of set the context for us a little bit. But I wanted to just tell people in your own words, you know, about your role and what you do at CISL. There you go. You sabotage me. Commentators curse. Anyway, tell us what you do.
Fantastic. So I lead the Center for Sustainable Finance. Fundamentally, we have two missions. One, to bring sustainability into every financial decision, and two, to think about how to change the financial system to be able to invest, finance, insure into sustainable development goals. Now, the way we do this is really interesting in the sense that we do education, we do research, we're an impact-led institute within the University of Cambridge, but we also host leadership groups. And for CSF, we've got three of those: the Banking Environment Initiative, the Investment Leaders Group, and ClimateWise, which is our insurance platform. So fundamentally, we work with over 50 large financial institutions to think about all the different ways to embed climate, nature, and social into financial decision making. But we also work with a number of policymakers, financial regulators, organizations like Network for Greening the Financial System, to think about all the different ways in which we can tilt the financial system to be much more effective in financing the things that we need most in our lives, which is nature, ecosystem services, climate solutions.
Yeah, and that was obviously the basis of the conference at the Royal Society. We heard from the great and the good. You know, at one level, I suppose I felt a bit frustrated. You know, there was a lot of people saying there's a problem, and I think a lot of people know what the problem is. We don't want to restate that. But, you know, you've got into this piece addressing ecological risk as commercial risk. And I think, you know, what you spoke about, you obviously with that understanding that you've had from that engagement was very powerful. So tell us, you know, how do we stand in addressing ecological risk as commercial risk, and where do we need to go further and faster?
So my background fundamentally is in banking before I came into the academic world. And within banking, I was doing a lot of risk management. And I think the problem that we currently have is we know that we have loss of ecosystem services, nature-related financial risks sitting on our portfolios. What we're not doing today is we're not measuring it, we're not managing it, and we're not mitigating. So fundamentally, we are in this situation where we've started developing frameworks for understand how do you go from loss of pollinators into issues with agriculture, into changes in soft commodities pricing, right? Which is fundamentally a market risk, a very mainstream financial risk. Or how do you go from a withdrawal of water or water stress into, well, which organizations, if I'm a bank, do I work with, do I lend to, that fundamentally depend on water? How do I calculate what that withdrawal of ecosystem services would mean for my portfolio? And what does that mean for my very standard mainstream credit risk that I have in my portfolio? So we know that those chains exist. We have frameworks for figuring out how they are stretched. And we have some examples, some of them that we have developed, some of them that other organizations have developed, of where you say, okay, if I withdraw water, so if there's a water stress in Southeast Asia, and you look at the impact of that water stress on a portfolio of heavy industry clients of HSBC, you see that almost entire portfolio gets downgraded from investment grade into non-investment grade. So there are examples of these things, and you can draw that example for agriculture, and many more are being created. But outside of these examples, it's not a day-to-day thing that is happening. So we don't have, as of yet, financial institutions assessing these risks as their daily job and then managing and mitigating these risks.
But why don't they? I mean, they know this story. I've been around knocking on their doors, talking to them, practically every bank with solutions that kind of fix this stuff for them. And they're sort of, you get interested parties, but it doesn't really hit the sort of top table despite the rhetoric and being members of all these organizations. Is it because they sort of don't want to be the first one to declare a fire sale and then sort of see the loss of all the assets on their book being downgraded? I mean, why does nothing happen?
It's a really good question. And I think, it's quite funny because a year ago, we did a lovely piece on how to drive finance to emerging markets, which we called Everything Everywhere All at Once. And I feel like the answer to this question is everything everywhere all at once. And partly it's on the academic and the scientific community, because when we put numbers on how big those risks can be or are, the estimations on kind of in terms of financial language tend to be pretty low. So most of kind of estimations of physical sources of risk in investment portfolios that I see is quite low. And another reason is that and again, if I come into more climate bit of it, right? So if you have a bunch of physical risks on your portfolio and you have an insurance policy against them, a lot of financial institutions kind of go, that's okay, I'm insured, it's fine. And so I think there is perhaps a misunderstanding sometimes about how different bits of the financial industry work together. So
Absolutely,
fundamentally, kind of they're thinking about, okay, well, I have an insurance policy, but where that thinking is not going is, but that insurance policy is going to run off in 12 months' time. And yes, the next renewal might be more expensive, or the policy might not be there, in which case the risk will be mine. I think that's another reason. I think on nature, we're currently pricing nature at zero in most of our interactions.
Yeah.
And that's, again, another reason. And we really do need a lot of ambitious and enabling and consistent policy making on that. Because when financial institutions or businesses are starting to think about how to incorporate these things, they need one strategy and one clear enabling policy framework to go, okay, I know that we're transitioning as an economy as a whole, and this is where I'm going to send my money to.
Yeah, absolutely. So let's unpack that a little bit. I mean, when we've been around the journey through Finextra, Sustainable Finance.live, talked to the insurers, the reinsurers, the asset owners, managers, all the way through banking and so forth. And as you sort of say, everybody sort of thinks somebody else has got them covered because of the nature of the sort of, hedging, if you will, that goes on in the financial services industry, short-term, long-term views, all of these different factors. Is there one aspect of, the financial services industry, people pointing to long-term asset owners and pensions, etc., as maybe being one? But in your view, where's a place we should be focusing our efforts at getting them to move further and faster?
I think everywhere again. I think it's whichever bit of the financial industry you're working with, that's the bit that you need to concentrate. On the insurance side, insurers need to be louder about what are the risks that they're seeing. They have wonderful natural catastrophe models, which need to be updated for climate, and the results of those models need to be brought into the market in a very clear way. And they need to be saying, look, at this point, we're not going to be able to insure you, right? So that kind of conversations needs to develop. Pension funds, asset owners need to be pushing on, if I have a long-term view, and I know we will have to transition. And it's just a question of how we transition. Is it a managed transition, or is it a very abrupt market crash type transition where everybody's running for the door and people end up with fundamentally stranded assets? Let's start thinking through that transition in a much more structural way. Let's kind of go, okay, these parts of the economy will transition in these ways, and these parts of the economy need more cash to get there. And I think on the banking side, there is also needs to be an understanding that a lot of these risks will sit with banks. And therefore, banks need to be engaging with the market to help transition their client. And I also don't think that we should be pinning this only on the financial industry, right? Financial regulators, policymakers need to give the financial industry an industrial plan of how we're going to be transitioning, which has to be ambitious and it has to be consistent, and we cannot be U-turning on it.
Yeah. Now, I mean, gosh, that opens up a sort of, can of worms, particularly on the eve of a certain election, which may be when we're recording this anyway, and maybe there'll be a whole U-turn on, strong policy with regard to climate and nature in America. Who knows? But let's put this now in a global context. You've just come back from COP16 in Cali. That's sometimes known as the biodiversity COP for people that are more familiar with the climate COP. I suppose the headline that I'm reading is that we've had this failure of the finance being, to fill the gap. But you were there. What's your read on what you were listening to, hearing, involved with, and what we should take away from it and what needs to be done?
So I think if I go through what I think happened at COP16 in perhaps kind of a couple of buckets, right? Bucket number one, there were things that went right, okay? So there was a new subsidiary body on what was called Article 8J that was established to look at Indigenous rights and effective participation of Indigenous people and local communities in the CBD. That was a success. At the very, I mean, if anybody was watching the negotiations, as I certainly was, at the very end, after 2 weeks of negotiations, and after negotiators had pulled out an all-nighter, right before the question of quorum was pulled, which is actually what the question that stopped the conversation. So the COP was suspended because of the lack of quorum at the very end. So in the morning, they did manage to agree an establishment of Cali Fund on the digital sequence information and essentially how do we work on DSI. And there was also an agreement of alignment of biodiversity and climate. So those three things, I think whatever happens, those three things are the good of the COP16. The implementation, remember, this COP was put forward as the implementation COP after the COP15, where kind of the framework was announced. And one of the big things going into these COP was the National Biodiversity Strategies and Action Plans, NBSAPs. And there was, I think, some unhappiness with how many of these have been updated. And I think that deserves a slightly, perhaps a more nuanced take. And what I mean by that is we definitely need a continuous ratchet and update of NBSAPs. But if we're not providing emerging markets and developing economies with resources to enable them to write a proper NBSAP, to write a proper financing plan, why are we expecting them to do that amount of work? So I think it's a slightly more nuanced take. Yes, we absolutely need more NBSAPs. Yes, we need everybody's attention on them, but we also need resources provided to people to be able to make that happen. And I think that gets us to the slightly more contentious bit, which is the entire resource mobilization package, which is the thing that did not get agreed at COP16. And there, the biggest point of contention was the conversation around a potential new fund to be set up. And fundamentally, the two parties, the 2 points of view was, one was the current governance of the GEF and the Global Biodiversity Framework Fund, which, by the way, did get more money announced to it. So the GBFF has come into Cali at about 244 million, and then had just about 163 million added onto it. So not a huge amounts of money, and with some interesting creative accounting, because New Zealand contributions seem to be in both of those numbers. It comes up to about 396 million. So not quite the 200 billion that we need a year. But there was a lot of unhappiness amongst the developing economies about how the governance of that fund sits and how the governance why is it that emerging markets and developing economies are not getting the money that they need to invest in nature-based solutions, not at the speed and the scale that they needed. And therefore, they were calling for a new fund. And on the part of a lot of the more developed market, and EU is within that group, and Norway and others, their worry was, so we have 4 years, 4 and a bit years to deliver the GBF by 2030 and the goals of the Global Biodiversity Framework. How much time are we going to spend creating this new fund? It's an entirely new structure with an entirely new set of governance. So, that was one of those red lines. And that's the thing that negotiators could not find a way forward on. And that is the thing that in those final half an hour of negotiations where there was no compromise to be found.
So, I mean, I've only been doing this for, less than 10 years, and I speak to a lot of people who are doing it being a lot longer, but, it feels like the same kind of journey. You negotiate forever, people go home a bit early, which seems a bit crazy, so you haven't got quorum. You then have to go back again, then you negotiate a fund, then the fund doesn't actually deliver. So, that will be what we're talking about in a few years' time. Oh, they didn't actually deliver the money that they promised that they said we're going to. Then it doesn't get implemented on the ground. Then we find ourselves in the same situation we're in. That's a bit negative, but what can we do that, doesn't just follow the same old tropes and actually is more innovative? And that's where our audience of, climate, nature, fintech people that are used to building the Microsofts, the Revoluts of this world, get stuff done rather than just talk. What could be done for the innovators to actually change this around?
I think that's a really good framing, because I think actually when every one of us wakes up every morning, we go, what can we change in this world that we live in, right? And I think some of these things go to what kind of market solutions can be brought into the market to solve the problems that we've got. And from that perspective, your community of innovators can be working on things like, we have huge issues with finding ways to finance emerging markets. So anything that helps us improve the flow of finance between developed market and emerging markets would be a huge unlock. And there is some work ongoing on how to use public money to enable a much greater flow of private money. There is some stuff happening on guarantees. There is some stuff happening on securitizations. But if there's any other way in which we can find some thinking on improving that flow of money, I think that would be fantastic. I mean, we're doing quite a lot of work right now on risk perception. So if there are any wizards out there that can help us understand the risk perception of emerging markets, and whether the projects in emerging markets are as risky as they sometimes look to the outsiders, that would be fantastic. And again, then anything that works on financial inclusion, anything that works on looking at kind of monitoring the loss of ecosystem services and how that connects into the financials. All of those things, I think, would be fundamentally really welcome in the current economic sphere that we've got us.
Great. So the conference we just did, we looked at the sort of space industry, geospatial, asset mapping, linking to biodiversity databases, and then all the way through, the risk filters and the regulation filters into a trading platform. So we tried to show that complete day in the life of data from the natural capital world through to the financial world. Is that the sort of kind of arc that you're talking about with all the solutions in between?
Essentially, but also the kind of the top down and the bottom up connectivity, right? So if you're doing kind of geospatial stuff, also look how it can be connected with the interventions on the ground. I think that would be incredibly important. But also, I think we've done a lot of work on this, is we tend to think about nature finance as a very pure play impact investment, right? And that's where kind of it's really hard, and how do I get to invest in a rhino bond, and all of those things come from. But in all actuality, there are two parts of thinking about nature protection, nature restoration. One is, how do we restore nature that we already lost? The second, how do we reduce pressures on nature? And that's the paper that we published going into COP16. So thinking about all the different ways in which we can reduce the use of ecosystem services in mainstream corporates. Finance has a huge role to play here via their client engagement channels, right? So saying, if I'm engaging with a water company, how can I reduce, how can I finance the reduction of their water use?
Yeah.
Same for heavy industry. So I think there is also a huge amount of work and innovation that's required to be working with large industrials, large corporates, and thinking through more circular business models, thinking through kind of anything that can be done to reduce that pressure on nature.
Yeah, perfect. So let's just finish with your sense. You're heading now onto the next COP. Given everything we've just said, you know, I suppose there's a lot of cynicism around that. What's your take on what you're going to head into with COP28?
Well, that's again quite an interesting COP ahead of us, right? There are four big things under discussion. A new collective quantified goal on climate finance, so the new version of the 100 billion goal.
Yep.
And I think probably we'll see where it ends up, but it definitely has to be a lot bigger than 100 billion. Is it a 500 billion? Is it a trillion? The question is not only how much, but how is it structured? We need the private finance to be able to flow. We're never going to be able to do this with government money alone. So finding right structures that enables private money to flow is going to be key. Fund for responding to loss and damage is on the agenda. Article 6 of the Paris Agreement is on the agenda. And also one of the biggest things, because I think this is the last opportunity to encourage people to submit much more ambitious nationally determined contributions for the COP30 in Brazil, because ideally we would see those come in February next year already. We don't have that amount of time. So a ratchet of ambition and kind of going down to the detail of how are we going to transition over the next 5 years, and how are we going to get down to that 1.5 degree, 2 degrees maximum of warming that we've been talking about for so long.
Yeah. Well, it'll be so interesting to see how it goes, and perhaps we can invite you back to update everybody on your thoughts on that. And I'd certainly would love to talk to you further, but I think that's enough for now to chew on. So Nina Seega, thank you so much for your time.
Thanks, Richard. Lovely to have been on this program.